Warren Buffett, the most famous investor of all time, recommends investors to consistently buy an S&P 500 low-cost index fund and suggests it's the thing that makes the most sense practically all of the time. Most people who disagree with Mr. Buffett tend to be wrong, and it's hard to disagree with him on this one, as the S&P 500 has been on a great run. It's a fact that the S&P has had hugely superior performance over the rest of the world for the last 13 years. And this is largely thanks to the big tech companies, the Magnificent Seven, who have simply dominated the market and seen huge growth. For example, over the past 5 years, Microsoft have grown by over 223%. Google's parent company Alphabet has grown by over 193%. Amazon have grown by over 100%, and Apple has grown by a massive 287% over the past 5 years. This has meant that investing in an S&P 500 only fund compared to a world fund has been the better strategy over recent years in order to get higher returns. So surely the best future strategy is to continue investing in an S&P 500 fund over a world fund. After all, this is what Mr. Buffett recommends. However, this won't be my strategy. I won't be investing in an S&P 500 fund again, and in this video I'm going to tell you why, and why instead I'll be investing in a world fund and emerging markets fund to hedge my bets over which part of the world will dominate the stock market in the future. Before we begin, I need to put a disclaimer that I'm not a financial advisor, and everything in this video is not financial advice. I'm simply sharing my own strategy, so please take everything in this video with a pinch of salt. Now I've got that out of the way, let's get into it. The argument of whether to invest in an S&P 500 only fund versus a world fund or a specific country focused fund ultimately comes down to whether you think the US will continue to have better stock market returns than the rest of the world over the period you want to invest in. For me personally, I still have some doubts over whether the US will continue to dominate in the long term, and those doubts stem from 3 main reasons. So let's go through them. The first reason is that US and international market performance has historically moved in cycles. The US has of course had a much better performance in recent years, but this has not always been the case. If we look at the historical performance over the past 50 years, we can see US and international stocks have cycles of alternating outperformance. For example, the 1970s were dominated by international stocks, led by growth in the Korean and particularly Japanese markets. And this continued into the early 1980s too. Then for much of the 90s, the US dominated thanks to the dot-com bubble. In the early 2000s, international stocks outperformed, led by growth of key emerging markets such as China and India. But ever since 2010-2011, the US has seen complete domination in the worldwide stock market, led by the big tech companies and mainly the Magnificent Seven. Although past performance is no guarantee of future performance, this back and forth throughout history suggests that the cycle could very well be expected to swing back towards international stocks at some point in the future. Since 1975, the outperformance cycle for US versus international stocks has lasted an average of 8 years. We're currently 13.1 years into the current cycle of US outperformance, so this suggests that international stocks are well overdue their day in the sun. And that's reason 1, in that history has a knack of repeating itself, and history suggests international market outperformance is overdue. The second reason why I won't be investing in an S&P 500 only fund again is to hedge the risk of the US stock market collapsing. This may sound really unrealistic, but over the past century, there's been many times where countries have collapsed and investor returns wiped out in those markets. And this has been as a result of political upheaval, wars, debt crises, economic crises, and bubbles bursting. For example, in the famous Great Depression in the US, the market collapsed. It collapsed by 85%, and it took 16 years for the market to recover to its previous high point. In World War II, again, many markets collapsed, and a notable one was France, where their market collapsed by 83%, and it took 15 years to recover. Another good example is Japan. We saw earlier that Japan led international outperformance in the 1980s. However, in the 1990s and early 2000s, they had a complete economic collapse, leading to their stock market falling by over 75% in that period. It then took them over 34 years to get back to their previous high. In fact, the main stock market index in Japan, the Nikkei, reached a new all-time high for the first time in 34 years in February this year, February 2024, beating their previous high recorded in 1989. The length of time it took to recover shows just how big that collapse was. And all these examples show that if you are only exposed to one country with your investments, then you face the risk that that country could collapse due to whatever reason, and you lose a huge amount of money. Of course, with the US, a collapse doesn't look like it's going to happen anytime soon, and on paper, it looks like all the big companies of tomorrow will be US based, with the big tech and AI centered companies. However, over the long term, who knows what's going to happen? Some of the collapses throughout history here were not expected, and to reduce risk, to hedge risk, I'm choosing to invest in the World Index Fund. This allows me to get exposure to US companies with over 60% of the fund allocated to the US, but also be diversified across the world. So if the unthinkable does happen and the US stock market collapses, I have exposure to other country stock markets to fall back on. World index funds mimic market movements, so the percentage allocation to each market, each country at any one time is all dependent on how each market performs. For example, we can see how a typical world index fund has changed between 1987 and 2023 with these two charts which show the country weightings at each of those points in time. In 1987, Japan made up 35% of the world index, the UK made up 10%, and the US made up 37%. Whereas if we fast forward to 2023, Japan makes up just 6% of the same index, the UK 4%, and the US has jumped to 61% thanks to the continued dominance and outperformance of the US. So this shows how world index funds change their makeup to reflect which countries dominate the market at that point in time. So by investing in a world index fund, I always have exposure to the winners in the market, reducing my risk by not having to bet on one country or one sector. Instead, I'm betting on all of them. Of course, the US may continue winning for the whole period I want to invest, but I'm personally choosing not to take the risk of only betting on one horse. I have an investment time frame of around 20 to 25 years, and I really don't know what external factors will happen in that period. If I had a smaller investing time frame, I may have greater confidence to back the US only and take the risk, but over the time frame I have, I'm choosing not to, and I'm choosing to hedge my bets. The third and final reason why I won't be investing in an S&P 500 only fund again is the potential growth in the emerging markets and particularly Asian markets over the next 20 to 25 years. I really don't want to have FOMO if the emerging markets completely outperform the US stock market in this period. There's various macro trends which favour emerging markets this century and make that outperformance a possibility if emerging markets exploit the trends correctly. The number one trend is population growth and the makeup of that population growth. 6 billion people currently live in an emerging market country, which is nearly 90% of the world population. And it's expected that the proportion of the world population is likely to become even more skewed towards emerging markets over the next 50 years, as population growth rates are much higher in these countries compared to developed markets. This is likely to translate into huge increases in real spending growth in these countries and significant increases in GDP. Over recent history alone, emerging markets have seen much superior GDP growth compared to the US. Admittedly, this is mainly down to population growth rather than increases in productivity, but nonetheless, given population growth is likely to remain superior in emerging markets, this GDP growth outperformance is likely to continue. Whether the higher GDP growth in these countries will translate into good investment and stock market performance, we're yet to see, and most people will say it won't, as it hasn't in the past due to emerging market sensitivities to external factors such as the dollar strength and internal factors such as corruption and political upheaval. But I for one want skin in the game in case it does translate into good investment performance. A factor which may help this possibility is the fact that big tech companies within emerging markets are on the rise, and importantly they're posting good earning reports which may provide a solid foundation for growth in their emerging stock markets going forward. Tech and communication firms such as Samsung, Taiwan Semiconductors, Tencent, and Infosys now account for over 30% of the emerging market cap. If companies like this can continue their growth in earnings and profits, it could spearhead emerging market stock performance and better performance over the US. So that's the third and final reason why I won't be investing in an S&P 500 only fund, in order to have skin in the game for emerging markets. Overall, we've now gone through the reasons why I won't be investing in an S&P 500 fund going forward. This doesn't mean that I don't think that the US or the S&P will do well going forward, as I'm still invested in a world index fund, and most of that world index fund is made up of US companies. In fact, 60% of that fund, over 60% of the fund, is made up of US companies, and the big tech companies still dominate that fund, such as Microsoft, Nvidia, Alphabet, Amazon, Apple, and so on. By investing in a world index fund, it just means that I'm not putting all my eggs in one basket. Instead, I'm hedging my bets with exposure to thousands of companies outside the US, as well as exposure to companies in the US. So this means that if international stocks do have a cycle of outperformance, let's say emerging markets have a great growth period, then I get exposure to that growth and to that rise. And if the unlikely case happens where the US stock market collapses, it declines, then at least I have other countries exposed in my portfolio to fall back on and hope that they grow in the period where the US stock market collapses. And even if the case happens where the US stock market continues to outperform international stocks, then I still exposure to the US anyway through a world index fund. So overall, that's my strategy. Let me know your thoughts on it. If you'd like to see my specific portfolio, I made a video at the start of the year where I go through the portfolio's performance, but I also go in detail at the start of the video on why I chose the specific ETFs, the specific funds in that portfolio. So if that's of interest, check it out around here. But for this video, thank you for watching.